Now, the International Monetary Fund has signed off on nearly $1 billion in new funding for Kenya. That, of course, should ease pressure on government finances. Now, a statement from the global lender indicates that the board completed the fifth review under Kenya's extended fund facility and, of course, the extended credit facility. That allowed for an immediate disbursement of about $415 million. It also extended those arrangements to 48 months from 38 in order to give Kenya more time to implement reforms. Now, a new 20-month arrangement under the IMF's Resilience and Sustainability Program, worth about $551 million, was also approved and will help to support Kenya's climate resilience efforts. Now, the IMF also says that Kenya has made some good progress in implementing economic reforms, and that's despite facing the worst drought in decades, as well as a challenging external environment. Well, let's get into all that now with Reginald Kadzutu. He's a financial economist and also an associate lecturer at the Oxford Brookes University in the UK. Mr. Kadzutu, always good to have you with us on the show. Well, talk to us about how significant this disbursement from the IMF is for Kenya, especially right now, relative to its current financial situation and, of course, Kenya's current debt position.
Thank you. It's always a wonder and a surprise when you hear IMF speak about Kenya, because then we are always wondering, are we looking or talking about the same country? The disbursement that is coming will definitely help the financial situation in the country, considering the government has close to $250–300 million of external debt due this year. And another whooping close to $500 million due next year. With the sliding of the shilling, $415 million immediate disbursement will go to show up the foreign exchange reserves, which might give the central bank a bit of headroom if they want to try and ease out the depreciation of the currency, and then save the country from the effects of that depreciation of the currency. So it is a good shot in the arm, but an unfortunate shot in the arm, because then our reserves currently are pretty much composed of debt. We don't have foreign reserves out of real trade that has gone on, but our reserves are all debt funded.
It is interesting you say that, Mr. Kadzutu, because Kenyans seem to agree with you. We did see the IMF praising the government's progress in implementing economic reforms, including the 2023 budget and also that very controversial 2023 Finance Act. On the ground, not so much. People aren't so happy with this drive to raise funds. In fact, we're talking about possible protest in the city tomorrow. What's your take on the reforms so far, how they're impacting Kenyans and their sustainability going forward?
And unfortunately, I don't think there are much reforms that the Kenyan government has actually instituted themselves. What we are seeing most is IMF prescriptions, because IMF wants to see revenue mobilization. You find there are a lot of tax and also guarantee creditors that Kenya has the ability to generate revenue to pay back its debts, and the only way they know how best to do that is to tell the country to increase its tax revenue. And we've heard the government coming to say that our tax revenue is 17%, we need to increase it to the 20s, to the 30%. I think there's a lot of public project appraisal that has not been done, where we want to look at the social value of the projects that they want to do. So the reforms we've loved to see, number one, is a reduction in the nominal value of the budget deficit, because the government has a budget deficit of 785 billion this year, which is just adding to the debt pressure that they already have. So I don't think there are reforms that are actually being done to bring financial stability and economic stability for the country in the next 3-4 years.
And I'd like to get your take on Kenya's current public debt situation. We saw debt was close to $70 billion in April. That's about 2/3 of the country's GDP. They say debt servicing costs currently take up over half of the country's tax income. Yet we're hearing that Kenya is still looking to raise funds through another syndicated loan. How do you feel about Kenya's current debt position and its move to continue taking on this debt?
It's actually dire, the current debt situation. And the problem with the debt situation in the country, number one, is average tenure of all the debt the country has around about 8.8 years. If you look at the terms of the debt that is maturing, even if you look at just domestic debt, close to 45% of the domestic debt is maturing in the next 5 years. 45% of 4 trillion is around 2 trillion maturing in the next 4.5 years. So the refinancing risk on the Kenyan economy is so high, and we have seen the government now borrowing at rates upwards of 17%, close to 20% of long-term debt, 12 to 13% on short-term debt. That means the debt servicing cost is just going to continue increasing. So the debt situation is not sustainable. IMF classifies Kenya as a high risk for debt default. Why? Because the debt servicing costs are increasing. Because of the average tenure of their debt, their refinancing risk is so high. For example, external debt service to export is around 23%, 25%, and that's just interest. So if we now put in also the repayment of capital and principal, then you find Kenya is actually not able to pay its debt without borrowing more money. And that's why you find they'll continue getting more syndicated loans. So this year they're adding 785 billion on the debt portfolio. They have close to another 1.23 trillion maturing this year. I mean, that's debt that is going to be borrowed to roll over that debt. Same amount next year. Then they've added 785 billion on that debt. And Kenya right now is in the thrones of what we call serious debt trap, where they cannot repay their debt without borrowing.